A $10,000 raise sounds like $833 a month. In the case file we are about to rebuild, the increase in spendable cash is about $532 a month before state and local tax. Nothing has been stolen. The headline raise is gross pay. Your life is funded with net cash. Between those two numbers are retirement contributions, federal tax, Social Security, and Medicare, and depending on where you live, state or local tax. Let us account for the missing $301 line by line. A raise can move to 4 destinations. Cash now is the extra amount in your checking account. Tax is the additional liability created by the extra taxable income. Asset owned is money directed to retirement or another account that still belongs to you. Purchasing power is what the remaining cash can actually buy after prices and recurring costs change. One warning before the math: the amount withheld from a paycheck is not necessarily the final tax owed on the raise. Withholding is a prepayment system. Filing status, deductions, credits, other income, and state rules determine the final result. We are estimating liability with a controlled model, not predicting an individual paycheck to the cent. Our employee is a single filer whose salary rises from $150,000 to $160,000 in 2026. They contribute 6% to a traditional 401k, claim the standard deduction, and have no other income, credits, or benefit changes in this model. First destination, the retirement account. 6% of the $10,000 raise is $600. That reduces current spendable cash, but it becomes an asset owned by the employee. For federal income tax, the model starts with taxable income of $124,900 before the raise. Salary minus the $9,000 traditional contribution minus the $16,100 standard deduction. After the raise, taxable income is $134,300. The new salary minus a $9,600 contribution minus the same standard deduction. The increase in taxable income is $9,400. Under the 2026 single filer brackets, that increment remains inside the 24% bracket in this model. 9,400 times 24% is $2,256 of additional federal income tax. Now payroll tax, both the old and new salary are below the 2026 Social Security wage base of $184,500. The full $10,000 raise is therefore subject to 6.2% Social Security and 1.45% Medicare in this example. That is $765. Put the receipt together: $10,000 gross, minus $600 to the employee's retirement asset, minus $2,256 of modeled federal tax, minus $765 of payroll tax. The spendable cash increase is $6,379 a year, or about $532 a month. If we add a simple state and local assumption between $0 and $500 for the year, the monthly cash result falls to a range of roughly $490 to $532. Actual state treatment varies, so this range is an assumption, not a national rule. The cash increase is not the final experience. Now test purchasing power. Suppose this employee's household has $80,000 of annual spending that is exposed to a 3% price increase. That is a scenario, not a forecast. 3% of $80,000 is $2,400. Subtract that from the $6,379 cash gain, and the improvement in purchasing power is about $3,979 for the year, approximately $332 a month before any state or local tax. This does not mean inflation literally takes money from the pay stub. It means the same recurring life now requires more cash. A raise can be real, taxable, and valuable while still feeling smaller than expected because part of it is restoring lost purchasing power. Also notice the $600 directed to retirement. It reduced cash today, but it is not consumption. If an employer match increased as well, the employee's total compensation and asset growth could improve more than the checking account change suggests. We excluded any match, so the model stays conservative and visible. Your pay stub may disagree with this example for good reasons. First, withholding settings can overpay or underpay relative to final liability. Second, state and local income taxes vary. Third, health premiums, flexible spending, commuter benefits, or other deductions may change at the same time as the raise. Fourth, Social Security tax stops after wages exceed the annual wage base, while Medicare does not have the same wage cap. A raise that crosses the wage base can therefore produce a different payroll tax pattern. Fifth, a bonus may be withheld using a payroll method that looks unusually high, even though the final tax return reconciles total income and payments. And marginal rate is not effective rate. Saying that the last taxable dollars fall in a 24% bracket does not mean every dollar of salary is taxed at 24%. The brackets apply in layers. The clean comparison is not your old net paycheck versus an online tax slogan. It is old pay stub versus new pay stub, with every changed line identified, followed by a year-end check against actual tax liability. For your own raise audit, write down 7 numbers: the annual gross change, the change in taxable wages, the change in federal withholding, the change in payroll tax, the change in benefits, the change in retirement assets, and the actual change in net pay. Then, annualize the net pay difference and compare it with your tax return when the year closes. Finally, run one purchasing power scenario using the spending categories that matter in your household. In this case file, a $10,000 raise creates about $532 a month of new cash before state and local tax, plus $600 a year in additional retirement assets. The raise did not vanish. It split into different destinations. Next, we will open the most misunderstood payroll deduction on many family paychecks: health coverage. The premium is only the entrance price. The plan's full cost can be much larger.